Today in this video I'm going to talk about accounting cycle and analyzing transactions. Before we talk about accounting cycle, we have to understand what is accounting period. Accounting period is a set duration of time in which this 10 steps take place. A set duration of time in which this 10 step takes place. So it can be 1 month, 2 months, 6 months, or 1 year. Usually it's 1 year or 6 months or one. That being said, analyzing transaction is determining, identifying transactions, and then we have journalizing. Journalize is double entry system. So first we identify a transaction. A transaction might be owner puts 1,000 US dollar into the business. So we'll have cash debit, and then we'll have owner's equity credit. This is an example of journalizing. Ledger, on the other hand, can be let's imagine multiple cash accounts, multiple cash transactions. Uh, Somewhere we made debit, cash, debit. So we have 1,000 cash debit, 200 cash credit, and 500 cash debit. A ledger would be basically this plus this minus this. But there are two ways to do it: T table and another table. I will talk about it in a later on video. An unprepared trial balance is within that specific accounting period. Maybe it's 1 month, 6 months, or 1 year. Do all of the transactions, debit and credit, debit equal credit or not. So within all the transactions, does debit equal credit or not? So we can find that through ledgers. Ledgers can be calculated through journals, and journals are calculated because we identify or analyze the transactions. Adjust and post accounts. So as we have mentioned previously, accounting cycle is a specific duration of time frame. It can be 1 month, it can be 6 months, it can be 1 year. So there are transactions that relate to this or this or this that happens outside this duration. Let me give you an example. Imagine that this business conducts its operation accounting period in month. So in January 30, it incurred a transaction which was it bought $1,000 of product on credit. Now, a journal of that would be product debit, product accounts. account debit, and then we have accounts payable, credit. So product account debit 1000. I don't have the space, sorry. And accounts payable 1000 credit. So that would be the ledger. But on this transaction was repaid on February 1st. This 1000 was paid. So the journal becomes accounts payable 1000, cash, which is an asset, 1000, credit. Now the question is, does this 1000 belong here on February or on January? Because the transaction originally happened on January 30th, but it got repaid in February. The answer to the question is it belongs in the month of January. And that is what adjust and post accounts is all about. Some transactions that happened outside the accounting periods are being accounted for. Now, preparing adjusted trial balance is taking account for that post accounts and creating a trial balance. Prepare a financial statement. There are 4 financial statements. One is cash flow, and then income and income statement, cash flow statement, equity statement, and lastly we have trial balance. So these are the 4 types of statement, financial statement. I'll get into closing accounts, post closing trial balance, and reverse and post later on. But this is quite close to the 5th step. 8th step is quite close to the 5th step, and the 9th step is quite close to the 6th step. Moving on, I have an exercise where we are going to analyze transactions. So first of all, what are transactions? What are the rules that define transaction? Measurable in monetary value. So it has to be measurable in monetary value. Impact on financial statement. Remember uh, I erased it. The 4 financial statements we talked about: income statements, trial balance, equity statements, and cash flow statements. And then exchange of value, whether or not there has been exchange of value. Now let's look at the exercise. Hiring of a new manager. Is it a does it have an impact on monetary value? No. Impact on financial statements? No, there's no money associated with it. Exchange of value? No. This is not an transaction. Car stolen from the register. Cash stolen from the register. 500 US dollars. Measurable in monetary value? Yes. Impact on financial statements? On financial statements, you're gonna have this exchange of value. Yes, it's a